my son was asking, while it's going like this, what do we look for? What's the draw on liquidity? Where do we look to see price going? Where is it likely to go to next? Well, we don't look at just the original consolidation here and think to ourselves, okay, well, all we're going to do is look at the high and the low, and that's all that matters. Because I'm never teaching trading in this consolidation to get to just this level. That's too small. It's too myopic, and you're not going to do well if you're just looking at it like that. So what are we supposed to be doing? Well, you got to come off that 1 minute chart and go at least up to a 15-minute time frame. So with a 15-minute time frame, you can see that we had relative equal highs here. So that was an obvious level to do what? Anticipate price wanting to clean up this area up in here. So just like we have here, there, and we had sell side there. Now, while it's moved up here and we've moved sideways, inside this pre-market opening before 9:30, we were in a small little range, which was part of this consolidation here. What is it more likely to do if you had control to steer price with the expectation of knocking out other traders so that way you could take their position over where they get out with a loss? Where they get out with a loss, your intention are to take that trade over exactly where they get out. Understand that these markets operate on the basis of liquidity. They seek yield, and they like to reprice to cause efficiency where there's inefficiency. When you take a step back and you look at it from that perspective, it makes things so much more simpler. Because wherever the maximum pain is, that's the path of least resistance for price. What does that mean? Because we moved off that 1 minute chart, a bellwether time frame for me is 15 minutes. Okay, so if I'm looking for something that is liquidity based, where I'm looking for a draw on liquidity that's going to have an impact for the session. I'm not talking about an hour candle where I can trade inside a 1 hour candle and I can get a scalp and I can make what an average person can earn in a week with every single 1 hour candle. I don't need to do that. You shouldn't try to do that. But for the sake of understanding the highest degree of probability where the market's going to reach for, you have to come off that 1 minute. You got to come off that 5 minute, go to at least a 15-minute time frame. Why? Because the majority of short-term fluctuations that's going on in intraday algorithmic price delivery is on that time frame. Now, I'm going to say it in simpler terms. The liquidity you're looking for as a general go-to that's going to serve you the best is a 15-minute time frame chart. That's the ones that are so clear and they're obvious. They don't hide them from you. They can never hide them from you because this is the first one they work off of. When we're in this little consolidation in here, which is all part of this larger consolidation that's to the left, you see all that? Where is the market jagged versus where it's smooth? Well, if you look at the difference between how this high and this high and this high and these highs here, you can pretty much see how these are all like real uniform. It's real smooth. It doesn't make any kind of real jagged run up and run away. Notice that? But where do we see that type of delivery and price? Down here. This is all jagged. They cut up all of the liquidity that was resting below that low. They ripped through it. It caused this one here. And then what did it do? It ran right up here, but then it left this nice smooth little area right in here. So what happens is that retail-minded traders, they see this price action and they envision this little area right in here, this little area right here where they feel that if they go into the marketplace and they try to go short, they feel that this is a safe room for retail traders because they trust this as what? They see this as resistance. They think that price cannot get through that. If it looks smooth like this, you can bet your ass they're running through that. Just like the SWAT team's going to kick that door in. They've already done the SWAT move down here. They've already busted through the door. It's all busted up and jagged. Here, it's all smooth. And they do this to instigate the idea that it's safe to trust that as resistance. So what will traders do? They'll want to go short. So when they go short, if they're thinking about protecting their money, and that's a good thing, they'll place their stop loss right above these highs. There's no need to go down below all this stuff or even revisit it when this is left intact. So if price is down here, how do we use that logic? So they tore us all up down here, and this is all left smooth and intact. So when we're in these small little consolidations like this, and you don't know what side the marketplace is going to run for, look for where it's left smooth edges. So while we're in here, we're going up into what? Time. All of the real moves, the sustained price runs that run for significant price runs to inefficiencies or liquidity are going to be based on a time delivery schedule. It is always based on time. Look at the macro. That's a small window of time. 20 minutes. 20 little minutes. Okay? And I can time every significant price run that's going to occur intraday on a 1 minute chart. That's what a macro does. Time is going to be the absolute paramount principle that is going to be the largest factor in why price is going to move. Don't believe me? Look at the economic calendar to cancel any argument against it initially right away. What do we have right there? It stepped outside of it. Did it stay there? No. Did it retreat away from it? Yes. But we're going into the time. What time? 8:30. But there's no news coming out at 8:30, Michael. It doesn't fucking matter because 8:30 is when the algorithm's going to do it. It doesn't matter if there's no news there. It doesn't matter if your economic calendar says there's a medium impact news driver or a low impact news driver or a high impact news driver. It's going to start running based on that time of day. Okay, listen, friends and neighbors, listen. If we can look at price like this, we can already come to the conclusion that we want to anticipate and expect and not be fucking surprised when the market goes up at 9:30 and into the lunch hour. Why? Because it has all of this and this on the daily chart to reach for. So if it's going to go above here, how far can it go past that ICT? Well, that's where this level came from. At 8:30, right here, that's when the market's going to start doing what? It's going to start going towards the pool of liquidity that it's going to aim for. So 8:30, we see it starting right there. It starts moving. We break out of this little area here, then it comes back down. And then right at 9:30, no escape. So we ran through it, took them out, and then for good measure, ran deeper. Come up to this level here, and then started pulling back. Because we failed to get to it there and we pulled back, it's trading in here for an institutional order flow entry drill, which is this little candle low here. It's part of this. This rip right here at 9:30. What time? 9:30. What time do these moves begin and run, ICT? 9:30, 8:30.